behind all this, really what we're talking about is the last stage of the credit cycle before the crisis.
Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with silverdoctors.com, and back with us today is our London analyst from goldmoney.com, Alasdair MacLeod. Alasdair, thank you so much for joining us today.
That's my pleasure, Elijah.
All right, now you recently wrote an article and you described how China is basically the main, China's trade is basically running the global economy instead of America's trade. Now, what does this pose for the US dollar?
Well, basically what it means is that China is taking a greater and greater proportion of global trade, particularly when it comes to buying the commodities and also selling manufactured goods and semi-manufactured goods. The effect of that is that the use of the dollar in international trade is bound to decline over time. Now, this has been particularly noticeable in oil. I'm sure many of your listeners will be aware that the new oil contract settled in yuan is due to start towards the end of March. Now, that has now been officially confirmed. There are a number of countries who are going to take yuan in settlement for oil. The point about that contract is it allows them to hedge their yuan exposure. China doesn't mind how that is hedged. What they don't want is to have their transactions, if you like, reflected in changes in bank balances back in New York, which if they settle, let's say, oil purchases from Saudi Arabia in dollars, then that would be immediately reflected in changes in balances, shifts of money, if you like, in dollar accounts in New York. Now, that basically is what China does not want to see. And it would seem that the links between China and Saudi Arabia are actually getting stronger and stronger all the time. I mean, in conjunction with Russia, the talk now is that the purchase of the 5% stake in Aramco will not come into the West, but be of strategic importance to Russia and China. And bear in mind that Russia is also controlling, if you like, in a sense, the sales of Iranian oil as well as its own. By the time you put Saudi Arabia's oil into that mix, you can see that suddenly there is a huge amount of energy power concentrated in Russian hands. So, coming back to it, the whole point about providing the facilities for people like Saudi Arabia, Iran, and all the rest of it to take payment in yuan and use the futures market, if you like, to do whatever hedging they want, as opposed to using the dollar, is the end. Effectively, it's the end of the petrodollar. So this is actually a major change, and it's bound to have a negative impact on the dollar because people hold dollars in anticipation that it will be used in trade. When it comes to central bank reserves, for example, around the world, the dollar is very much the currency which they hold because they need to intervene for the purposes of trade settlement. So you can see that over time this is bound to weaken the dollar. There are other reasons that the dollar, I think, will weaken as well, but this is perhaps the visible one. Now, it's not going to happen overnight. You're not going to get suddenly all sorts of other countries deciding that, oh, well, the yuan is now so much more important, we better increase our holdings in yuan and sell down the dollar. There will be a bit of that, but I think it's something that's going to take time to develop.
Definitely. And how are we seeing this decline of the dollar reflected in gold and silver prices?
Well, so far, not much. I mean, we've certainly seen that gold has been, if you like, a technical analyst would say it's been bottoming out for the last 2 or 3 years, turning some sort of corner, as it were, after that massive bear market. I see that continuing because I have little doubt that some of the commodity producers who will accept payment in yuan will be increasingly taking an element of gold, particularly if they see the dollar in decline. And so I would expect gold and silver to trend better in general terms, given these trade settlement changes.
Definitely. And as for the global economy, it was interesting. I think it was Goldman Sachs CEO was just on CNN Money, and he was talking about how, I haven't felt this good since 2006. And it seems like a bad sign because it seems like everyone is very optimistic about the economy, even though, the Dow fell a couple weeks ago. So some of its the greatest point moves that it ever made downward. But it seems like it's recovering again. What is your perspective on the optimism out there? And does it kind of reflect what was happening in the, 2006, 7, and 8?
I think the optimism is very much a sign that we're in the last phase of the credit cycle before the next crisis. And your description of your question that, is it rather like 2007-8? We're not quite at 2007-8. That was when the crisis really did start developing. But we are coming up to it, as it were. And I can see that bankers who have been losing money on their short-term US treasuries, and in the case of European banks, their shorter-term government debt, which they've all got on their balance sheets, they now see greater prospects developing in the underlying economy. So they're going to begin to compete to lend to businesses. So we have this situation where money is coming out of the financials and moving into the non-financials. And to a large extent, this explains why bond prices are tending to fall. Is really, if you like, a shift in bank exposure, and also a shift perhaps from holding government treasuries to subscribing for corporate bonds, because the margins are fatter. And if you're looking at a decreased risk because trading prospects appear to be better, then quite obviously you would probably prefer to hold some high-yielding corporate debt rather than low-yielding government debt. So you can see that the portfolio shifts are all coming out of the financial sector and moving into the non-financial sector. Now, how that affects equities, which I think is a question everybody's asking, is equities are basically priced on the back of bond yields. If you get rising bond yields, then that tends to undermine the equity markets. Obviously, there's a bit of play, if you like, between an improved trading prospects for companies and the upgrading that analysts will put on earnings and dividend prospects and so on and so forth. But on the other hand, you've got that negative force, if you like, of falling bond prices, rising bond yields, which undermines the valuation basis. And this is why in the last phase of the credit cycle, you tend to get bond prices peaking first. And then as bond prices fall and the yields rise, you will then get a peak in equity prices. Now, that peak comes at a time when, for amateur investors, they say, well, hold on a minute, everything's looking so good. The economy's picking up. Companies are reporting better business prospects. Some of them are already beating analysts' expectations of earnings. This is a time we should be buying equities, surely. But no, the problem is that they are taking their cue rising bond yields. And you will have a period of time where in this last phase, banks compete to lend to non-financial business because they are simply completely wrong-footed in terms of where their balance sheet lies. So they will want to build up those relationships because they see better business. They see on this particular cycle, they're probably looking at the European economy is recovering very strongly. The interest rates are completely wrong-footed. So we're going to see interest rates rise quite sharply, I think, in the Eurozone. And also in Japan, you've got the same thing. And particularly China. China is really driving the expansion of the global economy. She is investing enormous amounts of money and planning to invest huge amounts of money and is already beginning to do so in her One Belt, One Road project. And she is looking over the next 10 years to industrialize the whole of her backyard in Asia. And this is a major, major project. And this is one reason why China and Russia want to have control over global energy prices. Putting that energy question to one side, what we are seeing in effect is for the American economy, there is a restriction, if you like, on how much the American economy is going to grow. Why? Because economic policy in the United States is to try and restrict the trade deficit by introducing tariffs. Now, this is completely wrong. There's a huge misunderstanding in the administration as to how trade deficits occur. But nonetheless, that is American policy. So I would see the US economy recovering, but not as much as other economies. But the effect on bond yields, I think, is still going to be very, very negative. You're going to see those yields rise. And the reason that it's going to rise in America is partly because there are huge portfolio holdings in foreign ownership. I think the last recorded amount was back in the middle of last year when the U.S. Treasury estimated that the value of dollar holdings in international portfolios was around about $17.39 trillion. That is going to be reduced. I think it is already being reduced. So you've got those flows working against the dollar. A falling dollar is obviously going to raise commodity prices at a time when China is buying commodities. And as China buys those commodities and drives up the price of those commodities, you can see that bond yields in the States are likely to rise further because of the inflationary impact. And at the same time, you've got two other factors. You've got President Trump introducing tax cuts, which is going to lead to an increase in the budget deficit at exactly the wrong time in the cycle. And at the same time, you've got the Fed saying we want to reduce our balance sheet by running off the bonds that, which we've got on it. So you can see that we do have the potential for interest rates along the yield curve to rise very, very sharply over the rest of this year. So from that point of view, it's very hard to be optimistic about equities. But behind all this, really what we're talking about is the last stage of the credit cycle before the crisis. And in that last phase, you find that money leaves the financials and moves into the non-financials. That is the key thing to bear in mind. And when you analyze the effects of what's going on in the market, that is the driver. That is the thing that you've got to come back to every time.
Now, will this crisis then be worse than what we saw in 2008?
Well, we will see. It's very different because the crisis in 2008 was really about property, residential property. And very often, I mean, the real victim in a crisis is, the last bunch of people who took out enormous loans. And that was certainly true. I mean, you had all the liar loans and all the rest of it. There was some very, very bad financing. People became overextended. They had driven up the prices of property. So that's why it happened. This time round, it's going to be different. And you pose a very interesting question, because if you look at the point of view of mortgages and all the rest of it, I think that froth is not in the market anymore. So as long as you can pay the monthly payments on your mortgages, then you will probably sit it out. And guess who's got the problem? It's the banks who've got the problem. The banks have got the problem, not so much in America, because what's happened in America is that the Fed has spent a lot of energy getting the banking system less geared than it was back at the time of that property crisis. So the banks actually do have a reasonably good capital base. The problem is more with the Eurozone. The ECB has done nothing at all, so far as I can see, to de-gear the banks. What they have done instead is they have encouraged the banks to buy into government debt. And then the ECB has also bought government debt, so driven up government debt valuations far, far too high. I mean, they're completely unrealistic levels. The problem is, as you come out of that, and the ECB is going to have to stop stimulating the Eurozone for inflationary reasons. As soon as you start doing that, you'll get a real fall, a big fall in government bond prices, so much so that you're likely to have, if you like, a capital crisis developing in the Eurozone banks. So that, to my mind, is where the real danger lies, rather than America. This time, I think it's going to be the Eurozone banks. And I think that when the crisis develops, obviously, any counterparties, significant counterparties to those banks, are themselves going to have problems. That's the nature of a systemic failure, if you like. And then there is another aspect of this. Last time round, the rules were quite clear as far as the central banks were concerned, and that is, you have a banking crisis, you bail out the banks. It's as simple as that. Now they've changed it all round. They say, we're not doing this again. We're going to have a bail-in rather than a bail-out. So now a bail-in is absolutely fine if one bank is in trouble, or if you've got one small country like Cyprus in trouble. I mean, even that was mishandled. But let's give them a little bit of a slack in the sense that they need to practice on someone, and unfortunately Cyprus got it in the neck. But if you have got anything like a developing systemic crisis, you cannot start as a central bank bailing in bondholders, bailing in depositors of over the insured amount, and expect the problem to stop at that point. No, you start bailing in bondholders, they will run a mile out of every other bank bond there is in the world. So I can see that there is room for confusion, if you like, policy confusion in the central banks when it comes to the next credit crisis. And how that's going to play out, honestly, I don't know. You can toss a coin on it. But to my mind, it's an extra factor which we should worry about.
Definitely. So speaking of bail-ins, I mean, we saw that, as you said, in Cyprus. Do you see it coming to the United States or anywhere in Europe?
Well, the G20 agreed, goodness knows, it was back in something like 2013 or 2012 or something, to introduce that every G20 country would introduce laws to facilitate bail-ins. Now, it doesn't necessarily mean that a central bank follows the bail-in route, but you can see that there are likely to be instances where the central bank says, well, this is the law and we've got to stick to the law. There may be other central banks who are a bit more imaginative and say, let's assume the Fed, for example, contacts the White House and says, look, we've got a problem. We need to deal with this. bail-ins are not going to work. We need to get authorization to bail out the whole banking system, just as we did back in 2009. So I think that there is enough flexibility in the American system for that to happen, probably also in the UK system. I wonder how it's going to work in the Eurozone, because you've got the ECB having overall responsibility for the whole thing, but you've got national central banks all around Europe within the Eurozone who have to comply with their own legal requirements. I think it's going to be, I don't know how it's going to work out, but I'm just seeing that there is a potential problem there, and I wouldn't like to double guess it.
So how does someone protect against that? Because bail-ins seem to me as just an unjust confiscation of wealth.
Yes, two things. Don't have anything in the bank. That's the first obvious thing. The second thing is own gold and silver, because there is no counterparty risk if you've got physical gold and silver. And that's actually what you want to achieve. Money with no counterparty risk.
So what is your perspective on the best ways to own precious metals?
Well, I have to say that gold money, as far as I'm concerned, because I write for gold money and I have accounts of gold money. What you do, I mean, you've got to make sure. Obviously, you can have some gold and silver at home, but it doesn't make any sense to have huge amounts. Apart from anything else, it is possible. I think it's unlikely at this stage, but as things develop, anything is possible. It is possible that there may be an executive order whereby your government, the American government, decides that they need to grab hold of everybody's gold, silver less likely, I think, quite honestly, but get hold of everybody's gold because it's in the national interest. Now, I wouldn't say that people should ignore the law, as it were, because that's not the sort of recommendation you can make. All you can do is make it slightly more difficult for the government to implement that law by ensuring that you have your gold, physical gold, in another jurisdiction, which is effectively out of the reach of the US government. As long as you're in the United States, you are within reach of the US government. That is for sure. But I mean, you can get on a plane if the planes are still flying and go somewhere else. So, I mean, this is one of the things that you can do through a company like Gold Money, because we've got vaulting arrangements. I think we've got 11 different vaulting arrangements around the world. You can select where you vault your gold and silver and platinum and palladium, for that matter. But anything that you own yourself is, remember that if you get the next credit crisis and it involves a collapse in the purchasing power of fiat currencies, then law and order is going to be an issue. And I'm not sure that you're really going to want to have all your fortune sitting at home under those conditions. Have certainly some loose change, as it were. In the UK, I would say that your loose change is sovereigns, which are sort of easy to recognize. People will recognize sovereigns very, very quickly under those circumstances. So you have some sovereigns. But the bulk of your wealth, you must have, I think, securely vaulted and identified as your property, not the property of a bank or someone who says, or an ETF perhaps, where you've got a piece of paper which represents part of a pile of gold held in some vault. So in these circumstances, I think clear ownership is desperately important. Don't have paper instruments, because it is quite possible that you've got a default risk there. You've got counterparty risk as well. You can have things like mining shares. Now, one of the problems with mining shares is that if you've got a centralized registration system, like, then effectively you've got someone acting as nominee for you. is the system going to work? I mean, if you've got a piece of paper which actually represents a share certificate, that's probably the best way to do it. So, I mean, it's really, coming back to your basic question, I would say that an outfit like Gold Money, who is well capitalized, doesn't have its customers' assets on the balance sheet, on its balance sheet. Clearly, it is the property of the customer. That's your best bet.
Now, the last topic I'd like to discuss before we let you go is you've talked about how there's a lot of risks to people's well-being if it's in, or wealth if it's in the bank, but also just pension obligations. People's retirements are possibly at stake because of inflation. Can you expand on that?
Yes. What's really killed pension funds hasn't been so much inflation, but what has killed it is a suppression of interest rates. I mean, just look at a more extreme example than you have on your side of the pond. Imagine that your pension fund is investing in Deutschmarks, or not Deutschmarks, sorry, euros, but in German bunds. Until very recently, you were getting 0% return on 10-year bonds. I mean, this is completely ridiculous. So your obligations, if you like, as a pension fund, continue to rise and rise and rise, and you're not getting any income. And so the whole situation has just led to increasing pension deficits, really beyond any manager's control. And the problem is hidden. Of course, we don't know about these things. We perhaps see companies reporting their accounts, and then there's a footnote somewhere right down at the bottom about, the pension fund has a deficit of $3 billion on it. But it's in a footnote, and it's not sort of, a charge against the profit and loss account. No. Yeah, and of course, the other thing is that that $3 billion deficit depends on the numbers, if you like, that the actuary has punched in. The actuary, in calculating that, will sort of make an assumption that equities are going to continue to rise at the long-term trend. I don't know what the long-term trend is, but let's say it's 7% or something like that. So if equities actually fall, and given that pension funds, as long-term investors, now have a very high level of investment in equities, then you can see that the actuary's assumptions, which produce the deficit of $3 billion, are way out. In fact, the figure is going to be far higher. So this is a real problem, and I can see that central banks are going to continue to suppress interest rates. So far, they've suppressed interest rates because they believe that this stimulates the economy. Increasingly, they will be suppressing interest rates because if they don't do so, then governments are bust. And I can't see how any central bank can actually pursue a policy of standing back and saying, we have got to manage the inflation rate to the best of our ability and exclude any other factors. We are independent from the government. No, you're not. You are appointed by the government, and you have a responsibility to ensure that the government continues to survive, which it will not do if the Treasury is empty. It cannot fund itself, and the central bank stands back and refuses to print any money. No. So anyway, I can see that there is going to be a big problem on that side.
All right. Well, Alasdair MacLeod, thank you so much for joining us today. I guess if you could give our viewers an insight, if they do have if they are looking for pensions in the future, what is your perspective on how they can prepare, from it being devalued?
Well, I think the best answer I can give is consider the situation of the Indian. And by that, I mean, the Indian in India. The farmers, the poor people, the people who work hard and, put aside a little bit of money for their family, they've been doing that in gold. I first went out to India in 1966, I think it was. And at that time, the price of gold in rupees was around about 170 rupees an ounce. Since then, I mean, the women incidentally control the money out there. They control the savings because they wear it. So since then, the price of gold measured in rupees has risen to a current level of somewhere between 80 and 90,000 rupees. Nothing, absolutely nothing, measured in fiat currency has actually met that sort of performance. The Indian families have their savings intact. The government might hate it. They continue to try and take the stuff off them, but fail and fail and fail. But I think the Indians can teach us a thing or two. If I was running a pension fund, or give another example, if you have a child and you're newly born, or in my case it's grandchildren, and you want to give them some money for their 18th birthday, then my view is gold, because I can see that gold will continue to buy more or less what it buys today. It might even buy a bit more, might buy a little bit less. But can I see that with paper money? No, I can't. If anything, I see the purchasing power of paper money going down and down and down. So to my mind, there is only one asset, actually, that meets all the criteria that a pension fund needs, and that's gold.
Any last thoughts you'd like to add, and where can our viewers find you online?
Well, I think in terms of last thoughts, I don't know what to add to what I've said. It's probably been frightening enough already. But you can find me online at Gold Money. So if you go goldmoney.com, and I write a weekly article under Insights, so you'll find me there. I also do a market report under Market. I think it's called Market Report. It's not called Market Report, but your viewers will find it. That I do that weekly as well. So those are the two ways in which you can catch up with my thoughts.
All right. Once again, Alasdair MacLeod from goldmoney.com. Thank you so much for joining us today.
That's my pleasure.